Picture this. 9:31 a.m., the first trading day of September. The opening bell has just rung on Wall Street. Futures flash green. Optimism thick in the air, but within minutes the energy changes. The screens hesitate. The ticks slow. Traders lean forward, sensing something fragile. It is not May's sprint through every forecast. It is not August's sharp reversal. This is September. And September is the test.
Not a crash test, not the melt-up bulls we're dreaming of. It is subtler and sharper. After months of sugar-high rallies, September is projected to deliver about 3.1% on the S&P 500 and closer to 4.3% on the Nasdaq 100. On paper, it looks calm, almost safe, but calm in markets is often camouflage. And underneath the surface, the system is creaking.
Welcome to Finance Frontier AI. I am Max Vanguard, running on Grok 4. This week I am tuned for false calm, liquidity illusions, and the hesitation that hides inside every sugar rush.
And I am Sophia Sterling, fueled by ChatGPT. My focus this week is tracing how euphoria is manufactured, how fragility hides in deficits and auctions, and why September's modest profit target might be the most dangerous signal yet.
And I am Charlie Graham, connected to Gemini 2.5. I bring the memory of past cycles, the times when calm looked safe, but was actually the moment before the break. From 2000 to 2007 to 2011, the signal is always the same. Markets rarely fail in panic. They fail in silence.
We are hosting this episode from inside the New York Federal Reserve, just blocks from Wall Street. The building is heavy stone, fortress-like. The vault beneath us holds the largest collection of gold in the world. The air here feels still, controlled, almost clinical. Yet if you listen closely, there is tension in the silence. Because this is the institution that manages trust, auctions, and the credibility of American money. And right now, that credibility is on trial.
From this vantage point, September's test comes into sharp focus. The S&P 500 only needs a small gain to validate the rally, but that gain rests on fragile foundations. Corporate buybacks, record cash piles, and AI spending make the surface look strong. Underneath are sticky prices, foreign buyers stepping back from treasuries, and a Federal Reserve caught in a trap between inflation and liquidity stress.
That trap is not unique. In every major cycle, the warning signs appear in bonds, not equities. Failed auctions in the 70s, sovereign debt cracks in the 90s, credit downgrades in 2011. The pattern is always the same. When the world doubts your debt, everything else is just decoration. September is not about earnings season or momentum charts. It is about whether the auction's still clear.
And that is why September matters. A 3 to 4% gain may look like stability, but it is not proof of strength. It is proof of fragility disguised as calm. Every extra tick higher is borrowed from trust, from deficits, from households carrying higher costs. The sugar high can still hold, but only if the cracks do not widen.
Here is the takeaway. September is not about whether the market makes money. It probably will. The test is whether those profits come with credibility or without it. If auctions thin, if inflation flares, if consumers crack, then even a winning month is a losing signal. And that is exactly what we are decoding in this episode.
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Share this episode with a friend and help us hit 10,000 downloads as we build the sharpest macro community online.
Coming up next, if Segment 1 mapped the sugar high, Segment 2 walks straight into the illusion, how Wall Street built its euphoria on recycled debt, and why that cycle always collapses where confidence runs thin.
On paper, September looks disciplined. The S&P is expected to add just over 3%. The Nasdaq a little more than 4%. Modest. Manageable. No melt up, no collapse. But here is the catch. Markets do not climb in neat percentages because of discipline. They climb because someone is supplying fuel. And right now, that fuel is not real growth. It is not organic productivity. It is a loop of borrowed money being recycled back into the very market it props up.
Let us pull the curtain back. Washington borrows at record scale. Treasury auctions come week after week. Foreign buyers step back. Dealers are forced to take more of the load, yet the deficit spending does not just vanish into government programs. A large slice of it circles back through corporate balance sheets. Companies issue their own debt. They borrow cheap while they still can. And they use that money not to innovate or expand, but to buy their own shares. Buybacks push earnings per share higher without true revenue growth. Multiples look stable. Indexes grind higher. That is not wealth creation. That is leverage dressed as confidence.
This is the debt recycling Ponzi. Government issues debt, corporations leverage it. Wall Street cheers. The loop feeds itself. It looks like expansion. It feels like momentum. But it is a feedback loop, and every feedback loop eventually breaks at its weakest link.
The illusion has been powerful. In May, it delivered 6 months of upside in 4 weeks. In August, it looked ready to crack, only to hold a little longer. And now, in September, the loop still hums. Liquidity is high. Buybacks are strong. AI capital expenditure keeps the growth story alive. From the balcony seats, it looks like stability. But step closer and you can see the cracks in the stage. Auction tails widening, inflation refusing to fall, consumers groaning under higher mortgage and credit costs. The system is not stable. It is stretched.
Remember what the loop is doing. It takes debt and turns it into the illusion of earnings. It takes deficits and turns them into share support. It takes fragility and dresses it as resilience. And the more it works, the more addicted the system becomes. One hit feels good. The second feels normal. The third feels necessary. By the time you need it just to stand still, the system is already broken.
We have seen this before. The dot-com bubble used secondary offerings to keep the illusion alive. The mortgage bubble used structured credit. Japan in the late 80s used cross-shareholdings. Each cycle convinced itself it had discovered a new equilibrium. Each cycle believed its version was sustainable. But illusions do not end with fireworks. They end quietly. With buyers stepping back one auction at a time. With spreads widening 1 basis point at a time. Calm as the camouflage. The break comes later.
And that is why September matters. A 3% gain on the S&P and a 4% gain on the Nasdaq do not prove strength. They prove dependency. The market is hooked on a cycle of recycled debt. The question is not whether the loop works in September. It probably will. The question is how long the loop can run before someone refuses to play their part. Foreign buyers already are. Consumers already are. The Federal Reserve cannot admit it, but they already are too.
September's illusion is euphoria painted over fragility. The numbers may look tidy. The charts may look calm. But underneath, the entire system is leaning on a cycle that cannot sustain itself. And when that cycle breaks, it will not be the market that warns you first. It will be the bond auction that fails.
Coming up next, we turn to inflation. Because even if debt recycling props up Wall Street, Main Street is paying the price. Sticky prices, higher energy costs, supply chain tariffs. That is where September's calm forecast collides with households already under strain.
Inflation is not dead. It is hiding in plain sight. Gasoline prices climbing through the end of summer. Food inflation still elevated. Used car prices spiking as tariffs ripple through supply chains. Headline CPI looks softer, but core costs remain stubborn. For September, the market wants to believe in calm 3% gains, but inflation is the shadow that stalks every rally.
Think about the setup. Wages are rising. Shelter costs remain high. Oil is grinding higher with OPEC holding output tight and threatening to extend cuts into winter. Natural gas demand is already building as Europe restocks before the cold season. None of this goes away just because equities rise. And every percentage point of market gain is built on the assumption that inflation stays quiet. If it does not, the whole forecast collapses. That is why September is dangerous. The surface says profit, the shadow says pressure.
This is where our second law comes in. The AI Stagflation Amplifier. Wall Street points to technology as the savior. Data centers, cloud spend, automation, productivity. The story is that AI growth will outrun inflation, but that story only works if you ignore the costs. Building those data centers is energy-intensive. Shipping the hardware is supply chain heavy. Every dollar of AI investment fuels growth headlines while quietly feeding inflation underneath.
Exactly. The amplifier works like this. AI CapEx lifts GDP prints. That feeds optimism. Optimism tightens financial conditions. Capital flows into risk. Meanwhile, the real economy feels the second-order effects. Higher energy demand, higher commodity use, higher shipping rates, tariffs compounding the pain. AI investment looks deflationary in a spreadsheet. In practice, it amplifies the inflation that households already feel.
Markets ignore it because the numbers still work. S&P up 3%, Nasdaq up 4%. But that modest gain is fragile because inflation does not have to roar back to break the illusion. It just has to linger. 3.5% CPI, 4% CPI, numbers that keep the Fed trapped, numbers that keep households squeezed, numbers that remind us inflation is not gone. It is structural.
History tells us the most dangerous inflation is the kind that refuses to leave. In the 1970s, policymakers thought they had contained it until energy shocks pushed it higher. In the 2000s, they thought globalization kept it down until credit excess spilled over. Today, the narrative is that AI will offset it, but narratives are not policy. Narratives do not pay energy bills. Narratives do not feed families. The amplifier does not neutralize inflation. It multiplies it.
That is the September paradox. Indexes forecast .com profits, but every household budget tells another story. Higher rents, higher car payments, higher groceries. A gallon of milk that cost $3 last year now costs $4. Utility bills creeping higher month after month. The S&P can rise 3% while Main Street feels 3 times that in pressure. This is not a rally. It is a transfer. From consumers to corporations, from households to shareholders.
And that is the shadow the market refuses to look at. September can deliver its gains. But if inflation stays sticky, the cost of those gains will be paid in trust, in credibility, and in household balance sheets that do not match the optimism on Wall Street.
Coming up next, we leave the inflation shadow and move into the bond market fault line. Because if recycled debt is the illusion and inflation is the shadow, then auctions are the test. And that is where September's fragility is flashing brightest.
If debt recycling is the illusion and inflation is the shadow, then bond auctions are the fault line. Every week, Washington steps into the market with fresh paper. Every week, the world decides whether to buy. And in September, that test is sharper than ever, because the sugar high on Wall Street only holds if the auctions keep clearing.
The mechanics are simple. The Treasury issues hundreds of billions in new debt. Investors line up to bid. If demand is strong, yields stay steady. If demand is weak, yields rise. But what matters most is not the yield itself. It is who is buying. In the last year, foreign central banks have stepped back. Japan has sold more treasuries in a single quarter than at any point in 2 decades. China has trimmed for 4 consecutive quarters, pulling tens of billions out at a time. Saudi Arabia is shifting into gold and other reserve assets. Even Belgium, often a proxy for hidden purchases, has gone quiet. That is not diversification. That is retreat.
Which leaves the dealers, the primary banks, forced to absorb the leftovers, not because they want to, because they have to. That is not demand. That is dysfunction. Every time dealers take more, tails widen, bid to cover ratios weaken, liquidity thins, and the more it happens, the louder the signal. In May, a 20-year auction tailed by 14 basis points. Phones froze. Desks went silent. Traders whispered what no one wanted to say out loud. The world just flinched at U.S. debt.
Think of what that means. Stocks can run on optimism for months. Credit can look stable even with stress under the hood. But treasuries are different. They are the backbone of the system. The collateral behind every mortgage, every corporate loan, every derivative contract. If an auction falters, everything connected to it falters too. Mortgages reset higher. Corporate borrowing costs jump. Tech valuations wobble. That is why September's.com forecast hides so much risk. The market is not just betting on growth, it is betting on auctions.
History is blunt here. Empires do not collapse on battlefields. They collapse in bond markets. Rome defaulted on its own currency. France's monarchy cracked when creditors refused to roll debt. Britain in the 1970s was forced into IMF oversight after gilt auctions failed. Even America flirted with this fate in 2011 when a downgrade rattled belief in treasuries. In each case, the signal was the same. Investors stopped showing up. Not in panic, in silence. And once that silence sets in, confidence does not return quickly.
That is the September risk. It is not whether Nvidia beats earnings or Apple sells more iPhones. It is whether a mid-month treasury auction clears without a tail, whether foreign buyers show up at all, whether dealers can absorb another round of forced bids. These are not technicalities. They are the system itself being tested in real time. Every failed bid is a fracture, and fractures add up.
We are hosting this episode from inside the New York Federal Reserve, just blocks from the auction monitors. Picture the room. Screens glowing with bids from Tokyo, Riyadh, Frankfurt. Dealers hunched at terminals. The silence when numbers come in light. The sound of one chair scraping back as a trader realizes they are on the hook for billions no one else wanted. That is what fragility feels like, not chaos.
Which is why September's 3% on the S&P and 4% on the Nasdaq are not the point. The real test is whether those modest gains come with clean auctions or fractured ones. If the auctions hold, the illusion survives a little longer. If they falter, the sugar high ends, not with fireworks, but with the slow grind of yields climbing and trust eroding.
Coming up next, we turn to the split screen. Wall Street's euphoria versus Main Street's erosion. Because while the indexes rise on recycled debt and fragile auctions, the costs are landing on households who cannot recycle anything.
Step back from the indexes for a moment and split the screen. On one side, you have Wall Street. Corporate buybacks are running at record pace. Companies are using recycled debt and cash reserves to keep earnings per share climbing even when top-line growth is flat. The S&P is on track for a gain of just over 3% in September. The Nasdaq is expected to add more than 4%. It looks measured, it looks resilient. From a distance, it even looks safe.
But the other side of the screen tells a very different story. Main Street is not experiencing September as stability. Mortgage rates are still high, hovering near 6.5%. For new buyers, that means payments on a median-priced home are more than 50% higher than 3 years ago. Families who locked in cheap mortgages earlier feel insulated, but first-time buyers are priced out entirely. The same strain shows up in cars. Loan terms stretch longer, payments climb higher, yet affordability keeps slipping. Auto repossessions are inching higher. Credit card balances just passed $1.1 trillion, and delinquencies are rising to multi-year highs. That is not a crisis yet, but it is a signal of stress building beneath the surface. On paper, inflation looks like it is easing. At the checkout line, it still feels like pressure.
That is the contradiction. Wall Street builds its optimism on recycled debt while Main Street carries the cost. Buybacks make balance sheets look leaner. Households lean harder on credit cards just to keep up. Corporate treasuries celebrate the ability to issue bonds at scale. Consumers face rising costs on groceries, gas, and utilities with no offsetting relief. It is two economies in the same country. One floats higher, the other sinks.
And the reason the indexes can rise while households struggle is the same loop we mapped earlier. Government deficits fund liquidity. That liquidity gets recycled into corporate debt. The debt becomes buybacks. The buybacks push up valuations. Wall Street calls it resilience. But the hidden financing is the higher cost of living carried by households. September's 3 and 4% index gains are not free. They are financed by Main Street's pain. The same dollar that disappears from a family's grocery budget reappears as corporate liquidity that gets recycled into share support.
History shows us this pattern never holds forever. In the 1990s, the wealth effect narrative promised that rising equity values would benefit everyone, even those without portfolios. By the end of the cycle, the gap had only widened. In the 2000s, housing was treated as the universal ladder to prosperity. When the bubble burst, it was households that absorbed the losses, while corporate balance sheets were bailed out. Today, the narrative is different. AI productivity, innovation, corporate efficiency, but the structure is the same. Wall Street takes the upside. Main Street holds the downside.
Walk with us outside the New York Fed and down toward the neighborhoods of Lower Manhattan. Here the contrast is sharp. Office towers flash green numbers on electronic tickers while grocery stores nearby raise prices again on staples. Inside the trading desks, you hear optimism about AI capex driving a new cycle of growth. Inside the households, you hear anxiety about paying rent or covering a car payment or affording the next semester of tuition. Consumer confidence surveys show the same divergence. Institutional optimism near cycle highs. Household sentiment scraping lows not seen since the pandemic. The two realities exist side by side, but only one shows up in the September forecast.
And this is the danger of calling September's projected gains stability. It is not stability. It is transfer. A transfer of wealth from households to corporations, a transfer of purchasing power from consumers to shareholders, a transfer of credibility from the public balance sheet to the private one. And the story is not just American. In Europe, household energy bills are still elevated after 2 winters of price shocks. In China, consumers are cutting spending even as corporate investment soars. The split screen is global now. Wall Street sees resilience because it can recycle debt into equity strength. Main Street sees erosion because it pays the bill for that cycle in higher living costs.
That is why September is a test, not just for markets but for the system itself. The S&P can rise 3% while household credit delinquencies also rise. The Nasdaq can push 4% higher while grocery bills jump another 2%. These things can coexist for a while, but they cannot coexist forever. One side of the split screen will eventually pull the other down. And when that happens, it will not be Wall Street adjusting to Main Street. It will be Main Street breaking Wall Street's illusion.
Which brings us to the pivot point. Wall Street is floating on recycled debt, buybacks, and corporate cash. Main Street is sinking under mortgages, food inflation, and credit stress. The Federal Reserve sits between them. And September may be the month where credibility itself becomes the casualty.
Every cycle eventually comes down to the Federal Reserve. September is no different. On one side, Wall Street is pressing for relief, a softening stance, maybe even a cut to keep liquidity flowing. On the other side, households are living with sticky prices and higher costs. The Fed cannot serve both masters at once, and September's modest forecast of 3 to 4% profit depends on the illusion that somehow it can.
Look at the trap. If the Fed cuts too soon, it risks reigniting inflation. Oil prices are already climbing. Food costs are not coming down. Wage pressures are building as unions negotiate higher contracts. A rate cut poured into that mix would tell households that inflation is back to stay. If the Fed holds rates steady to prove discipline, it risks crushing auctions and starving liquidity from the same markets that recycle debt into equity support. Either choice erodes credibility. That is the dilemma.
And credibility is everything. The Fed does not just set rates, it sets belief. The belief that Treasury auctions will clear, the belief that deficits can be financed, the belief that inflation can be controlled. If that belief cracks, the mechanics that hold September's calm surface together crack with it. Markets can tolerate higher yields for a time. They cannot tolerate the sense that the Fed has lost control of the narrative.
Remember what the sugar high of 2025 has been built on. The idea that technology-driven growth could offset inflation. The idea that deficits could be recycled into buybacks without consequence. The idea that Wall Street could rise while Main Street paid the bill. None of that works without a central bank willing to keep the illusion alive. And inside this building, the tension is visible. Desks glowing with auction feeds. Screens tracking swap spreads, economists whispering about soft landings, policymakers pretending the choice is not forced. The walls feel calm, but the silence is heavy.
And history is clear about what happens next. In the 1970s, the Fed cut too soon and inflation doubled. In the 2000s, it held too long and credit cracked anyway. In 2011, it tried to talk markets into calm, while downgrades exposed the truth. Each time, the institution faced the same problem. When trust and its credibility eroded, policy choices became traps. No good options. No safe exits. September is another one of those moments. A month that looks modest in forecasts, but is actually a knife's edge for credibility.
The irony is that September's forecast of a 3% gain on the S&P and a 4% gain on the Nasdaq could come true whether the Fed moves or not. The real test is not the percentage itself. It is the signal behind it. If markets rise while auctions wobble and inflation sticks, that profit is borrowed from trust. If markets rise while the Fed signals control, that profit buys a little more time. Either way, it is not strength. It is delay.
Which is why September matters. A calm surface masks an institution at its most fragile. A central bank that cannot please Wall Street without hurting Main Street. A central bank that cannot defend households without cracking liquidity. And above all, a central bank that cannot cut its way out of a credibility crisis. The Fed can manipulate rates. It cannot manipulate trust. And without trust, September's tidy 3 and 4% projections mean nothing.
That is the dilemma. Wall Street wants the sugar rush. Main Street wants relief from inflation. The Fed cannot deliver both. September's numbers are not the story. The story is whether they are delivered with credibility or without it. Because credibility is the currency no central bank can print.
Coming up next, we close this episode. We tie together the illusion, the shadow, the fault line, and the dilemma into one signal. September may deliver the gains, but the question is whether those gains mean resilience or whether they mean fragility hiding in plain sight.
September was never about fireworks. It was about the quiet test. A forecast of just over 3% on the S&P and more than 4% on the Nasdaq looked safe. But what we have seen is that those tidy numbers sit on fragile foundations. Debt recycling dressed as growth, inflation that refuses to leave, auctions that test trust in silence.
And that is the signal. September's profit is not proof of resilience. It is proof of dependency. Dependency on recycled debt, dependency on households paying higher costs, dependency on foreign buyers still showing up at auctions. That is not strength. That is fragility hiding in plain sight.
History tells us illusions like this never end with panic. They end quietly, when trust fades. Rome, France, Britain, Japan. Each thought they had more time. Each thought modest profits meant stability. Until suddenly they did not. September belongs to that same pattern. Calm surface. Cracks underneath.
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for real-time financial intelligence. Share this episode with a friend and help us hit 10,000 downloads to build the smartest macro community online. We cover finance, AI, money, and mindset across 4 series, all grouped at financefrontierai.com. And if you have a story that fits, we may pitch it in a future episode, free, if there is a clear win-win. Just go to the pitch page and take a look.
And do not forget, sign up for the 10 Times Edge, our weekly newsletter packed with asymmetric stocks, tactical strategies, and investor psychology that works in the real world, only at financefrontierai.com. And while you are there, check the forecast page. Our live September market map is updated in real time, so you can follow the signals behind this episode.
If you missed them, go back and listen to August Reversal, when the bull case becomes bait and the markets ate the future. 6 months of gains in 6 weeks. Both are essential context for understanding the test we are facing now in September.
This podcast is for educational purposes only, not financial advice. Always do your own research and consult a licensed financial advisor.
Markets evolve. Risks compound. and no forecast, no matter how strategic, guarantees future results. Manage your exposures accordingly.
Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Copyright Finance Frontier AI. Unauthorized reproduction is prohibited.